Same price, same candles, same time, same instrument. One trader opens this chart and sees noise, random movement, unpredictable fluctuations driven by forces too complex and too numerous to analyze with any reliability. They reach for their indicators, the moving averages, the RSI, the MACD, and try to impose order on what appears to them to be fundamental chaos. Another trader opens the exact same chart. They see something completely different, not different data. The data is identical. The same opening prices, the same highs and lows, the same closing candles. The chart is the same chart. But what they see in it is a different reality. They see intention. They see institutional fingerprints. They see the specific, recognizable pattern of behavior that large capital produces when it enters and exits markets. The structural signals that separate where smart money has been, where it is positioned now, and where it intends to take price next. They are not smarter than the first trader. They are not working harder. They are not using better indicators or more sophisticated software. They have simply learned to see what the first trader cannot see. And learning to see it, truly see it, not just intellectually understand that it exists, changes every chart you will ever open for the rest of your trading life. This is how you learn to see it. What smart money actually is, not the myth, the reality. Before you can think like smart money, you need to understand what it actually is, stripped of the mystique, the conspiracy theories, and the deliberately vague language that most trading educators use when discussing it. Smart money is not a secret society. It is not a shadowy cabal of bankers meeting in dark rooms to decide where markets will move. It is something far more mundane, far more understandable, and once understood, far more tradable. Smart money is institutional capital. The pension funds managing retirement savings for millions of people. The investment banks deploying capital on behalf of their largest clients. The hedge funds running quantitative strategies across hundreds of instruments simultaneously. The central banks managing national currency reserves. The insurance companies allocating billions in premiums across asset classes. These entities share three characteristics that define everything about how they move markets. First, they manage enormous amounts of capital, not millions, billions, sometimes hundreds of billions, capital so large that deploying it in any market, buying or selling, moves price against them. A pension fund that wants to buy $1 billion of a major currency pair cannot simply place a market order. The order would push price upward before half of it was filled, making the purchase progressively more expensive. This is the central problem of institutional capital, size. And the solution to this problem, the specific behavior that smart money must engage in because of its size, is exactly what creates the footprints that alert traders can read. Second, they operate on long time frames. The investment thesis of a major institutional fund is measured in months and years, not hours and days. When a hedge fund decides that the dollar will strengthen against the euro over the next 6 months, they build a position designed to be held for that duration. This long-term orientation means that smart money positions are established slowly, deliberately, and at price levels chosen for their structural significance rather than their short-term momentum. Third, they leave evidence. Every order placed in a liquid market creates a footprint in the data. Every accumulation phase leaves structural signatures in price action. Every distribution phase creates patterns that, to the trained eye, are as distinctive as a fingerprint. Smart money cannot hide its activity. It can only act within the constraints of its size, time frame, and objectives, and those constraints create the observable patterns that smart money thinking teaches you to recognize. The fundamental shift from price to purpose. Here is the single most important cognitive shift that separates smart money thinking from retail thinking. Retail traders look at price. Smart money traders look at purpose. Let me show you exactly what this means. A retail trader opens a daily chart on U or USD. They see a 3-week downtrend, lower highs, lower lows, consistent bearish momentum. They see their moving average sloping downward. They see the RSI showing oversold conditions. They apply their analysis and conclude the market is bearish. Continue short. A smart money trader opens the exact same chart. They see the 3-week downtrend, but they do not stop at what price is doing. They ask why. Why has price been declining consistently for 3 weeks? What structural purpose does this decline serve? Who benefits from lower prices? Who is accumulating at these lower levels? Where is the logical termination point of this move, the level where the purpose of the decline has been fulfilled? These questions, purpose, beneficiary, accumulation, termination, produce a completely different understanding of what the chart is showing. The retail trader is reading the chart. The smart money trader is reading the intention behind the chart. And intentions, once you know how to recognize them, are far more predictable than prices. The 4 phases, the language smart money speaks. Smart money does not move randomly. It operates in a consistent, recognizable 4-phase cycle that appears on charts of every instrument, every time frame, every market in the world. Understanding these 4 phases is the foundation of smart money thinking. Once you can identify them, once you can look at any chart and place it in its correct phase, the random noise of market movement begins to resolve into readable, anticipatable structure. Phase 1. Accumulation. Smart money wants to build a long position. It wants to buy large quantities of an asset at low prices without moving price against itself during the buying process. To achieve this, it needs 2 things: low prices and willing sellers. The accumulation phase creates both. Price is depressed, either through the continuation of a previous downtrend or through active selling by the institution itself, which drives price lower specifically to create the low levels at which it intends to buy. At these low levels, retail traders who have been watching the decline are either short, positioned for further decline, or deeply reluctant to buy, afraid of catching a falling knife. Both groups are potential sellers, exactly what the institution needs. The institution buys from them, quietly, gradually, over days and weeks. Each time retail selling pressure pushes price down, institutional buying absorbs it. The price does not crash further. It does not rally significantly. It oscillates, creating the sideways, range-bound price action that is the visual signature of accumulation. This range looks to the retail trader like indecision, like a market waiting for a catalyst. It is not indecision. It is a loading dock. The institution is loading its position. Phase 2, the markup. Accumulation is complete. The institution has built the position it wanted at the price levels it targeted. Now it allows price to rise. The markup phase is the directional move that retail traders chase, the trending, momentum-driven advance that produces the setups that most retail systems are designed to enter. But here is the problem. By the time retail traders recognize and enter the markup phase, the institution is already positioned from accumulation. The retail entry is occurring at significantly higher prices than the institutional entry. The risk-reward for the retail trader is dramatically worse than for the institution. And at the top of the markup, when the trend is strongest, when the chart looks most bullish, when the retail trader is most confident, the institution is preparing for Phase 3. Phase 3, distribution. The institution wants to sell its position. It wants to sell large quantities at high prices without moving price against itself. This requires buyers, and it requires that those buyers be confident enough to buy at the high prices the institution needs them to buy at. The distribution phase creates this confidence through the same mechanism as accumulation, a sideways range at the top of the markup. The range looks like consolidation before a further advance. Retail traders, positioned long from the markup and expecting the trend to continue, add to their positions. New buyers enter, attracted by the strength of the preceding uptrend. The institution sells to them, quietly, gradually, over days and weeks. Each time retail buying pressure pushes price up, institutional selling absorbs it. When distribution is complete, when the institution has sold everything it bought during accumulation, it withdraws its support. Price collapses. Phase 4, the markdown. This is the mirror of the markup, the declining phase that follows distribution. Retail traders who bought during distribution are now trapped in losing positions. Their selling, as they eventually cut losses, adds to the downward momentum. The institution, now short or flat, profits from the decline. And at the bottom of the markdown, when the chart looks most bearish, when retail sentiment is most negative, the institution begins accumulating again. The cycle repeats. This is not a theory. This is the documented observable behavior of institutional capital in liquid markets, described by Richard Wyckoff nearly a century ago and as relevant today as it was in 1930. The Wyckoff cycle, accumulation, markup, distribution, markdown, is the language smart money speaks. And once you learn to read it, every chart you open is a sentence in that language. The fingerprints, what smart money leaves behind. Knowing the 4 phases is not enough. You need to know how to identify which phase a market is in, and, more specifically, how to identify the specific structural signatures that smart money leaves at the critical transitions between phases. Fingerprint 1. The spring. At the end of accumulation, just before the markup begins, smart money frequently executes a specific maneuver designed to perform 2 functions simultaneously. It pushes price briefly below the lower boundary of the accumulation range, below the obvious support level that has been holding for weeks. This push below support does 2 things. First, it triggers the stop losses of retail traders who bought within the accumulation range, shaking out the weakest hands and creating a final burst of selling that the institution absorbs. Second, it creates a false signal of breakdown, drawing in retail short sellers who believe the range is broken to the downside. Both groups, the stopped-out longs and the new shorts, are sellers. The institution absorbs their selling as final accumulation. Then price reverses, aggressively, back above the support level, back into the range. This reversal, the snap back above support after the false breakdown, is called the spring, and it is one of the most reliable, most consistently profitable smart money trading signals in existence. The spring is the institution's last purchase. The next move is the markup, fingerprint 2, the upthrust. At the end of distribution, just before the markdown begins, the mirror of the spring occurs. Price pushes briefly above the upper boundary of the distribution range, triggering the stop losses of shorts and drawing in breakout buyers. The institution sells into this buying. Then price reverses back below the distribution range, and the markdown begins. This false breakout above resistance, the upthrust, is the institution's last sale. The next move is the markdown. Fingerprint 3, the volume signature. Every phase of the smart money cycle produces a specific volume signature. Accumulation, high volume during downward pushes, selling being absorbed, declining volume on upward bounces, less interest in selling at higher prices within the range. Markup, expanding volume on upward moves, declining volume on pullbacks. Distribution, high volume on upward pushes, buying being absorbed, declining volume on downward moves. Markdown, expanding volume on downward moves, declining volume on bounces. These volume signatures, the relationship between price direction and volume, are the institutional fingerprint on every phase of the cycle. When you see high volume on a downward move within a range, and that move does not produce a new low, the selling is being absorbed. Accumulation is occurring. When you see high volume on an upward move within a range and that move does not produce a new high, the buying is being absorbed. Distribution is occurring. Volume tells you who is winning the battle between buyers and sellers, not by what it shows in isolation, but by what it shows in relation to the price movement it accompanies. How to see with smart money eyes. Practical application. The framework is clear. Now, the implementation. Step 1. Identify the current phase. Open your weekly chart. Look at the last 6 to 12 months of price history. Ask, where is price in the smart money cycle? Has there been an extended downtrend followed by a sideways range? That is likely accumulation. Watch for the spring. Has there been an extended uptrend followed by a sideways range near the highs? That is likely distribution. Watch for the upthrust. Is price in a markup or markdown? Identify the direction, and look for pullbacks that offer entry in the direction of the smart money flow. Step 2. Find the key structural levels. Within whatever phase you have identified, mark the critical structural levels, the boundaries of the accumulation or distribution range, the significant swing highs and lows that define the phase's structure. These levels are where the transitions occur. The spring happens below the lower boundary of accumulation. The upthrust happens above the upper boundary of distribution. Your trades will be structured around these levels. Step 3. Wait for the signature. Having identified the phase and the key levels, your only remaining task is to wait for the specific signature that confirms the transition you are anticipating. For the spring, a push below support, followed by a strong reversal back above support, ideally on increasing volume. The entry is on the reversal, as price recovers back into the range. For the upthrust, a push above resistance, followed by a strong reversal back below resistance. The entry is on the reversal, as price collapses back into the range. For markup entries, a pullback to a rising support level, ideally coinciding with the previous distribution range or significant structural level, followed by a reversal candle at the level. For markdown entries, a rally to a declining resistance level, followed by a reversal candle at the level. Step 4. Execute with structural precision. Stop loss, below the spring's reversal low for long trades, above the upthrust's reversal high for short trades. At the logical structural level where the smart money signal is invalidated, take profit, the opposite boundary of the range for spring and upthrust trades. For markup and markdown trades, the next significant structural level in the direction of the move. Position size 1% risk, always. Regardless of how clear the smart money signal appears, the chart you could not see before, now you can. Return to the opening image. 2 traders, same chart. The first trader still sees noise. The moving averages are crossed. The RSI is showing a reading. There is a pattern somewhere in the candles that might be a setup. You are the second trader now. You see a 6-week accumulation range, recently completed. You see the spring that occurred 3 days ago, the false breakdown below support, the aggressive recovery, the high volume that accompanied the recovery telling you that institutional buying absorbed the final retail selling. You see the markup beginning. You see price moving away from the accumulation range with expanding volume and large-bodied candles. You see the next significant structural level, the prior distribution range, the previous high, as your first target. You see the logic of the move, the institutional intention behind it, the structural purpose being served. You see the trade, not because the chart changed, because you did. Smart money thinking is not a strategy. It is a perceptual upgrade, a fundamental change in how you see the relationship between price, volume, and institutional behavior that operates beneath the surface of every market movement. Once you have it, you cannot give it back. Every chart you open will show you what it showed you before, and more. The noise will still be there. The random fluctuations will still occur. But beneath them, visible now where it was invisible before, you will see the structure, the accumulation, the distribution, the spring, the upthrust, the markup, the markdown, the 4-phase cycle that smart money has been running on your charts since the first day you opened a trading platform, while you were looking at indicators that were built on the surface and missing the intention underneath. The charts have not changed. You have, and they will never look the same again.